Apple, ticker AAPL, turned $416.16 billion of revenue into a net margin of 28%. Very few companies keep that much of what they earn. Here is how the consumer electronics company does it. Behind that margin sits a business built on hardware people don't want to give up, plus a growing web of services layered on top. iPhone, Mac, iPad wearables, and a subscription arm that includes the App Store, Apple Music, and Apple Pay all feed into the same pool of revenue, and each layer tends to carry richer margins than the one before it. Revenue actually dipped in 2023, down to $383 billion, before climbing back to $391 billion in 2024, and then up to that $416 billion figure this year. Earnings per share tell a sharper story. EPS sat almost flat, around $6 for 3 straight years, then jumped to $7.46, a jump that's partly about selling more, and partly about Apple buying back so much of its own stock that each remaining share now owns a bigger slice of the profit. That buyback pattern also explains one of the strangest numbers on Apple's whole balance sheet, a return on equity of nearly 149%. That's less a sign of supercharged growth and more what happens when a company spends years shrinking its own equity base through repurchases while profits keep climbing. On the balance sheet itself, Apple is holding $35.9 billion in cash against $98.6 billion of total debt, so on paper it's running a net debt position. The current ratio sits right around 1, and the quick ratio is closer to 0.8, numbers that might worry you in a smaller company, but matter less here given how reliably Apple turns sales into cash, generating $98.7 billion of free cash flow this past year. That said, free cash flow has actually slipped for 2 years running, down from $108.8 billion in 2024 and $111.4 billion back in 2022. Which brings us to the price tag. Apple trades at a price-to-earnings ratio of just under 35, a price-to-sales ratio near 9.6, and a price-to-book ratio above 42, that last number mostly a reflection of that shrunken equity base again. Compare that to Microsoft at a PE of 25.8, Alphabet at 17.9, and Meta at 20.8, and Apple comes out the most expensive of the group on almost every measure. Its PEG ratio, which weighs price against expected growth, sits at 2.68, well above Microsoft's 1.39, Alphabet's 0.9, and Meta's 0.79, meaning the market is paying a much bigger premium for each unit of Apple's growth than it is for its closest peers. The stock has climbed 47.7% over the past year, touching a high of $340 before pulling back to around $305 today, sitting just under its 50-day average and comfortably above its 200-day average. A beta of 0.78 means it has historically moved less than the broader market, and its worst drawdown over the period was a relatively contained 13.8%. This is not a name that swings wildly. So the picture here is a company converting a huge share of every dollar it earns into profit, with a fortress-like ecosystem and a calmer stock than most of the market, but also priced richer than any of its closest peers on nearly every valuation measure, at a moment when free cash flow growth has cooled and earnings gains lean partly on buybacks rather than pure sales growth. Whether that premium reflects the ecosystem's staying power, or whether it leaves little room for a stumble, is very much the debate playing out among investors right now. If breakdowns like this are useful to you, stay subscribed so the next one doesn't slip past you. Drop a comment with the company you want pulled apart next. We're always building the list from viewer suggestions. And one last thing, nothing here is financial advice. It's just a walk through the numbers, so treat it as a starting point for your own research, not a final answer.